Kitco Mining special coverage of PDAC 2024 is brought to you by Gold Mining, Uranium Energy Corp, and Uranium Royalty Corp.
The seventh record year for Triple Flag. This is Paul Harris for Kitco Mining at the 2024 Prospectors and Developers Association Conference in Toronto, Canada. And joining me today is Shaun Usmar, CEO of Triple Flag Precious Metals. Shaun, welcome back to Kitco.
Thanks, Paul. Good to see you.
Well, a seventh record year of results for the company in 2023. Congratulations. What were some of the highlights for you last year?
I think just consistent execution. We've delivered 105,000 ounces last year, exceeding our intermediate peers. We were the only group to actually put out guidance for this year that was up on the prior year. Everyone else was down. We continue to project growth well beyond that. But the main thing is cash, run rate, and optionality with a great balance sheet. So we integrated Mavericks in the beginning of the year successfully. We are still looking at 90% cash margins, cash run rate around $40 million US a quarter. Our net debt is about $40 million US, so we'll pay that down super quickly. Nearly $700 million in liquidity. And the key thing that informs this is we've got a lot of insider ownership. So just consistently delivering value, and you'll see about a 20% CAGR year on year over the last 7 years. More growth now and more growth into the future, but on a per share basis, that's what really matters.
Okay. You mentioned your guidance for this year is up on last year. Where's some of the growth to come from in your current portfolio?
We always think about risk, right? And it's a portfolio to your point. So out of 235 assets, that growth the ounces have already come from 32. So think of that as 70 to 80% in NAV. You'll find that in a very similar way when you think that risk of a producing mine or mines that are ramping, that are established, is lower than one that has to maybe be permitted, established in that. So the bulk of that growth is coming from established mines that are ramping, and in particular, our cornerstone, about a quarter of our net asset value is from Northparkes in Australia. They're entering into E31 North, which is a high gold grade zone. And so you'll see a material increase in gold and silver coming out of Northparkes. Now remember, that's a multi-decade long mine, and it's just a great transition for us. So think about risk and think about ramping assets. We're not waiting for Hail Marys on mines that still have to come into production.
I'd like to talk about the precious metals environment at the moment, price environment, and copper environment as well, actually. Metals are at very good levels. Gold's having a very, very good week. For you, will this make deal flow harder to come by? How does it change the dynamics?
No, actually, on the contrary, if you think about it this way, the bulk of our ounces come from polymetallics. I think this form of financing works best when you can offer a very competitive cost of funding to particularly a base metal or PGM producer where the gold or silver byproduct is really not core. So think of it this way. We're 75% roughly gold, we're about 20% silver, and the rest is copper and nickel. And those ounces that we tend to get from polymetallics, when the gold price or the silver price is high, it's just worth more to those base metal or PGM producers at that time. So it's actually a really good deal environment for us. Okay, well,
let's spin that question around. The copper price, it's been historically very good, but its growth has stalled or it's been stagnant. And last year was terrible for the nickel price, I think, down 45, maybe 50%. And this year has been started by a raft of companies mothballing, curtailing production. How do you see the environment for the base metals and feed that into potential deal flow for you guys?
So firstly, we're in a cyclical industry. Things ebb and flow. I've worked in base metals for most of my career and ferrovanadium and other businesses like that. You have these periods where I think at moments like this for those commodities represent a really good time to try and get your house in order, get your cost structure right, and reset for a more favorable point in the future. So I think those teams and those businesses that have great assets can actually look to, perhaps if they've got the multiple or the valuation or access to capital, look to actually grow and set their business up for the future. So we see some businesses like that where they have a longer term view. I think for some it's clearly a difficult time, and I think for the first time in quite a long time, we're also seeing businesses, maybe not the majors, but intermediates and others who have suffered what you've explained and really are looking at either ways to enhance their liquidity or improve their balance sheet or strategically give themselves more flexibility at a time when valuations for possible targets and that are probably looking quite good for them.
In the copper sector, the tailwinds are very strong. But copper deficit's coming. Depending who you speak to, that could get to as much as 5 million tons a year by 2030 and beyond. And yet there doesn't seem to be a lot of investment in developing new projects. There doesn't seem to be a lot of M&A. That's what a lot of the copper development stories lament. But as a company that writes checks, what's your view about what's happening or where we are in the copper cycle? Why aren't things moving quicker than perhaps people think they should be?
It's so interesting. I was at a sector leader dinner last night where this topic was really on display, where the projections out of the US, for example, over I think 2035, looking for a doubling of copper supply in order to meet some of the demand projections, then people just don't know where it is going to come from. I think we've seen others like the Chinese and that take very long-term strategic views. And I'd say for us, we have failed to invest on a longer-term horizon in the space. So I think that's clear for everyone to see. I do think we have seen some assets trade. There's not a lot of them. Everyone's looking for it, including gold players. So you look at what MMG did recently. That was a significant price and a very big investment that they made in Botswana. Of course, we've seen Evolution take out CMOC now with Northparkes, which we're very happy to have, Jake and his team now as our new partners on that asset. I think there's a lot of people looking for these. And I also think there's interesting opportunities on brownfields situations. I think the biggest opportunity, though, is that people continue to underestimate the need for staying power and the time it takes from successful exploration in order to actually deliver first pounds of copper out of any investment opportunity. We are seeing some groups who see that and I think are providing perhaps some risk capital or talking to us and others as to how they can perhaps be part of that. But it's just not enough of it. And I think the only other feature when I think about the space right now is it's probably not helped by the challenges that I think we've seen on the supply side, with the existing supply side, to continue to deliver into that. I think we've seen some ongoing disappointments, cost and capital inflation, which I think is probably given a number of investors pause. So I think it's still a really interesting environment.
Given some of the other risks you just alluded to there, the sort of country risk, political risk, financing risk, CEO risk, the incentive price isn't high enough by a long shot for companies to take on these risks. I'm not going to put you on the spot and ask for what you think the incentive price will be, but do you think that the price needs to go much higher for all these risks to be assessed and, okay, let's do it, let's hit that development button?
I think the short answer has to be yes. Just look at where the cost curve is, look at the supply projections. It wasn't that long ago, copper was at $2, $2.50, and long-run pricing at $2.50 or so seemed like a really good thing. But consider the inflation and the cost move that we've seen over this time. The cost of securing new ounces and the timeframes involved, the permitting. I think investors continue to underestimate just what that entails. So I think the short answer has to be yes. And you don't have the supply-demand dynamics. You mentioned nickel. You see what Indonesia has done to just flood supply into the market and create this sort of structural overhang. You don't have that same challenge in copper. I mean, the fundamentals are seemingly very sound.
Okay, despite good fundamentals and historically very good prices, equities, whether it's gold, copper, continue to be in a slump. Why do you think that is, and what do you think is necessary for that to change?
I think it was just over a year or so ago. At least at conferences like the ones we've just been through or this, there seemed to be a sentiment that inflation is behind us and some of the worst of what we experienced during COVID is sort of come and gone. But I think we're seeing at the moment that that's really not true. There's concerns again as to what might happen with what's happening with the conflict with the Red Sea. We know what happened with supply chains during COVID previously. And we are still seeing the lingering effects of cost inflation, labor and skills scarcity in certain areas. We're not through that. So I do think that's an ongoing challenge. And on the one hand, you've mentioned, the country risk thematic is big. We've lost 1.5% of supply there. That has to come back, hopefully. It's hard. Now, there's ore bodies, there's challenges with skills, and look at the demographics of our sector. We have failed as a sector to bring in just good new talent, whether it's at a university level or beyond. And I think those are some of the biggest barriers to actually generating the future supply we need, as well as creating the conditions on permitting to help attract more sensible risk-adjusted capital into the space.
Okay, we were both at the BMO Metals and Mining conference last week. Interested in your breakdown of meetings between things you're potentially interested in investing in and investors potentially interested in investing in Triple Flag. What message are you hearing from investors or potential investors?
I must admit, I went to the conference not knowing what to expect because I've been to conferences earlier this year where I'd say the mood was very subdued. I had a slightly bipolar experience because I think in some ways there are commodities that have suffered big write-downs, teams that are dealing with some of that. Country risk was an evergreen thematic in a number of our meetings, and how do we think about that as we constructed our portfolio. But as a business, we ran dual tracks this year for the first time. We're a relatively young business. We had an incredibly busy investor schedule, practically no time available, some interesting journalist interest, which I was encouraged to see, and it'll be interesting to see how some of that translates. And also some really interesting business development possibilities that have come onto our menu that candidly weren't there just over a week ago. So as much as the mood felt quite subdued in some ways, our actual activity was very interesting.
Well, let's follow up on that point, Shaun. With the low valuations on a lot of single asset developers out there, do you see this as a great time of opportunity for Triple Flag to put some more things into your pipeline?
I do. I think I think the challenge we're facing right now is, I think we've demonstrated discipline over time. It does feel like a moment here with the dynamics I talked about earlier, where some are looking for more liquidity, perhaps looking at it strategically to acquire new businesses or build counter-cyclically. And they're really finding the traditional markets are unsupportive right now. So we're very actively engaged. I think that's meant for us, though, a lot more work. The odds in the sector are usually not in your favor on delivering things on time and on schedule. So we're doing a lot more analysis to say, if things don't go to plan, what does that look like? And then being quite discerning as to how we then deploy capital. But I think it is a very interesting time. I also think it's an interesting time there are management teams out there, even though their equities are under pressure, their multiples are probably doing better than perhaps others have, or perhaps then because they've executed and others perhaps haven't. So I think for businesses like that, if they have a license to do things, I think it's a very interesting environment for businesses like that. I'm on the Alamos board. That team has done a wonderful job of executing successfully. I think there are management teams like that investors are recognizing where the rest of the sector is perhaps struggling. Everybody still feels undervalued, of course, and if you look at where the commodity price is and you look at valuations, it's like, wow, something's not working here. But cycles come and go. I think it's a good time.
In terms of things that management teams are perhaps not licensed to do at the moment from their shareholders and the board, M&A seems to be right up there, despite the fact we've got relatively low market capitalizations. There's still not a high velocity of transactions taking place. Does that surprise you? And what do you think it would take for that to change?
Look, I've had the good fortune of being in businesses over the years that have grown substantially through M&A. I was an early executive in Xstrata with MEC, where we grew that business rapidly through M&A. With hindsight, people look back and go, that's great. But at the time, there wasn't a lot of conviction in 2002 or 3 through growing through M&A. I think there are management teams, if they have the ability to successfully execute and weather the short-term fickleness perhaps of the equity capital markets and views, it can prove to be a very interesting time. But those are quite specific opportunities and quite specific teams. I think the real differentiator is who can actually deliver. Again, I love what John McCluskey and the Alamos team did over time, how they've unlocked value in Island Gold as a good example. I don't think back when they did some of that, the markets initially celebrated it. They've now proven to be successful in their execution. I think you need teams who aren't going to just blow with the wind, and they see the opportunity and they can deliver.
I think you're right. I think some of the teams that have delivered smart or intelligent, successful M&A, the deals were poo-pooed at the time. Yeah. Now, you're a CEO who has delivered performance. Do you feel vulnerable as a takeover target?
I'm a shareholder first and foremost. My team has the highest insider ownership in the space. If we can add value either through M&A, as we did with Mavericks earlier on, or indeed if it turns out we're worth more as part of someone else's business, I'd welcome that. So, we're ultimately here to continue our growth of organic value and adding to the ecosystem in the mining space, generating returns for our investors. If we can add value through consolidation one way or the other, we're happy to entertain that.
I want to change track, Shaun. ESG has been a key part of how you've put your portfolio together. We spoke about this in the previous interview, how ESG was a fundamental part of the analysis you've done in the companies and projects you acquire. Last year was a tough year for ESG's credibility. And investor focus seems to have migrated to just the E, or environment, more specifically within that CO2 emissions, which is something that can be assigned a numeric value relatively well and coherently. How is your outlook changing in terms of ESG when you're looking at opportunities?
When we were private, the approach we took is the same then as it is as a public company, and it's the same now as it was a year ago. And that's not because we lack awareness of where the winds are blowing from an ESG sentiment perspective. It's just because fundamentally we're here to service the mining sector in a way that we think is authentic and makes sense. So for us, that means good partners with a good social license. We've seen a lot of situations this last year where things have been quite catastrophic on the social license in some other areas. You can't fix that through a rate of return. So that's table stakes, but I think it's a thing we do a lot of work on and we do very well. The next piece there is if we can enhance their privilege to operate with co-invest or social investments in local communities. I couldn't have done what I did in my career if I didn't have the benefit of scholarships at certain times. There's not a lot of mining companies doing that the way they used to, certainly when I was at school. And so for us, we put community scholarship programs in place. We help with some universities. We help with social license programs where there's good things. And then to your point, we track our carbon footprint with our activities. We want to be transparent, but we want to be authentic. We do offsets. And I think over time, what we can do is really help match best practices across our portfolio. But that's our approach. I mean, we're not trying to be all things to all people, or it's like, oh, the latest news is going in that direction. We're going to chase that. We're going to just stick to what we do. And if we can help our mining partners, we're going to continue doing that.
Okay. Now, to close off, Shaun, what are some of the exciting things we can expect to see out of Triple Flag this year? What are you really looking forward to?
I think the important thing is to just continue execution. Like at the end of the day, there's a lot of good teams in this space and a lot of people sound awfully undifferentiated in their strategic direction. I think what matters over time is what you deliver. You've seen our execution to date. We have a great balance sheet. We've got good, strong cash flow generation. Essentially, as I say, no debt. We pay a leading dividend. But ultimately, the deal environment now is set up to be as interesting as it ever has. But we're going to keep our form. We'll continue to see if we can execute sensible, accretive deals, continue to grow the portfolio and grow value. So it's as simple as that.
Well, it sounds like there's going to be a lot more news to come out of Triple Flag as time passes.
I hope so.
Well, Shaun, thank you very much for joining us today.
Thanks, Paul. Good to see you.
And this is Paul Harris for Kitco Mining at the 2024 Prospectors and Developers Association Conference in Toronto, Canada. And if you like what you see, don't forget to subscribe.
Kitco Mining special coverage of PDAC 2024 is brought to you by Gold Mining, Uranium Energy Corp, and Uranium Royalty Corp.